Okay, good morning. Today we're going to finish Chapter 11, starting with a question relating, we had this yesterday. We did earnings per share a week ago when we were in stockholders' equity, so this chapter, earnings per share, is kind of like a review, so we see it in two chapters. And earnings per share by itself is not a big deal, the concept of earnings per share. Earnings per share is basically saying what income is available to common shareholders divided by the number of common shares outstanding. That's it. So when we look at earnings per share, is the amount of company's net income per share of its outstanding common stock. So earnings per share is saying how much on a per share basis is this company generating for the common shareholders. And on Monday, we also talked about fully diluted earnings per share, and that's just a number that's smaller because we take any convertible preferred stock it has and pretend it has been converted and compute earnings per share then. Convertible preferred stock, just as a refresher, convertible preferred stock, those preferred stockholders can trade their preferred stock in for shares of common stock. Okay, so next up, so we've got announcements. We'll start with announcements. That question will remain open for a few minutes. So Chapter 11 homework is due this weekend. I will send out step-by-step videos. Okay, so then next up, let's see, final exam, just as a review here, our final exam runs Monday, May 9th through Wednesday, May 11th. You have to start it by 4 p.m. Wednesday. If the online sections schedule with Proctor use soon, they do, the more desirable time slots fill up. So your best bet is to register now and get the time slot you want. Okay, just hit the extra credit opportunities briefly here. We've got the My Accounting Lab homework, the assignment that is labeled extra credit assignment, and that is due Saturday, May 7th. We've got the photo extra credit contest. Those details are in Blackboard. It's due Saturday, April 30th, and the phrase extra credit contest is due Saturday, April 30th as well. The My Accounting Lab homework, if you do that extra credit assignment while you're working on it, and until May 8th, it impacts your grade in My Accounting Lab, the calculation of it. Starting Sunday, May 8th, that will be removed. I just can't remove it while it's an active assignment. Okay. So Monday's feedback, we had kind of two groups of feedback. The first set of feedback, the two were related to content. So the first thing we got here, let's see how I can do on answering this. And I paraphrase, I redid a little bit of the language. So if this is yours, I just fixed a few things. Would Anheuser-Busch purchasing Miller not be considered a monopoly? Well, there's a lot of breweries. There's a lot of craft breweries. I don't think we worry too much about having a monopoly in the beer industry because there can be other beer companies that crop up. It's not like a monopoly where we have to buy our electricity from First Energy or Ohio Edison. I think beer, there's enough alternate players that, and there's lots of craft beers too, so I don't think that's a problem. Second, but I'm not an expert on monopolies, but I would still say that I think there's a lot of players in that market. Second, is it normal for a growing company to have a slightly increasing operating expense to sales ratio? Yeah, that would be absolutely normal. There's no real rules for what's happening there. Growing companies can have growing expenses. Growing companies can have declining expenses, so there's not really, we don't know what we expect there. From an earnings quality standpoint, we would like to see those operating expenses declining, of course, but there's reasons, and it depends what the reasons are behind there. Okay, let's see. And then terms, definitions, I had some notes about, can you go over the formulas for whatever. I just wanted to point out to you that if you need more background, want more comprehensive notes, go to Blackboard and download the PowerPoints for this chapter, for any of the chapters, because the PowerPoints for the chapters have extensive notes in them, have lots of formulas on them. So there's something, another resource you can have. Of course, you should be reading the chapter as well. We cannot, in the class time we have, cover everything in the chapter. We're hitting the high points, the major takeaways. Okay, and then the next group of feedback I had regarded questions about the extra credit, so I thought it'd be worth going through those. Does our grade in My Accounting Lab include our attendance in-class quizzes? Yes. If you look in My Accounting Lab and click on My Accounting Lab Course Home from Blackboard and then go into, look at results, click on results, you will see a listing of all your scores to date in the class, and you'll see day by day what your score is in any given day. Then if you click on overall score, it'll give you an average for homework and average for quizzes. The in-class quizzes are in that quiz grade there. So they do absolutely count. Okay, is the new extra credit worth 1 point or 1 percentage point? Well, the extra credit will add, if you get it, adds 1 point to your overall grade. So at the end of the semester. So at the end of the semester, if you're sitting with an 89 and you earn, say, the photo extra credit 1 point, if you're sitting at 89, your overall grade would become a 90. So, okay, so next one here. Does the phrase have to look like the fancy one she shows in class? The phrase is completely typed. No. So I don't want a photo. All I want with the phrase is you to type a phrase in the text box in Blackboard. So there's no photo. You are not making anything like that. So you're just typing a phrase up to 120 characters. Okay, and then to follow up on that, your photo should be just a photo. I don't want a phrase superimposed on it. I need the photos because what I'm doing is I'm putting together a short video, welcome to the class for the fall, and I need photos for that. So I'm hoping for pictures of you next to your computer or you in class or any photo that you think is relevant. So I need photos. Photos with pictures, with words on them don't play too well in a video. If you want to put a caption for your photo, if you want to explain it in the text box, you can put up to 40 characters. So you can add a caption, certainly not required by any means. I actually prefer things that don't have captions. But again, photos of people are great. Just give me the name of the person in the email if there's people in it. Okay, and then the next one's just meant as humor. There was one comment that I thought was funny, and so a little sarcasm goes a long way once in a while. Okay, so the feedback was she made a 15-second rule that I was never told about. Someone should say something about this. So kind of funny. Yeah, and so when we're doing that 5-second rule, if it's a computation, I feel like if I just told you you divide this number by this number, you need a few seconds to do that. So anyways, this is funny, so I laughed. But just as a reminder, we do have the 5-second rule, and the 5 part I might change, but normally 5 seconds, so that's still in place. Okay, so the handout for today is online. It's the exact same thing we had from Monday. Oh, and I did want to make one comment here. So I also got someone saying, oh, the handout, too much is crammed on there. Well, first of all, we don't really have a budget in our department for making these handouts, and I just kind of started doing it mid-semester. And I really don't want to make any more copies than I have to. And so I I put some on there. There is some white space, but you'll have to supplement it with your own paper. I'm just trying to not hand out volumes of paper. Anybody physically in the classroom need the handout from Monday? It is exactly the same. Okay. I'm going to give you them and you can distribute behind you, okay? There's a couple people behind you if you would find them. Thank you. Okay. Anyone over here? Have you moved? No. Okay. Okay. So what we're going to be doing today is we're continuing with this idea of the income statement, and we are doing, remember, we're not doing linear objectives 2 or 3. So we're starting with linear objective 6 today, and 6 is looking at management's responsibility and the auditor's responsibility. So we're going to be talking about this. There are no numbers in this section. We're actually going to be looking at an auditor's letter and interpreting what's in that auditor's letter. So first off, we have some of these big ideas to go through first. And we had this one on Monday, but I think it's worth going over again. Every publicly held company is required to produce audited financial statements. Every publicly held company. So if you're traded on the stock market, you are required to produce audited financial statements. Okay, audited, the word audit, what it means is that an independent organization, an audit firm, comes in, and this is certified public accountants, they do the audit. They come in and they're independent, meaning they're not employed by your company. Your company pays their fee, but they answer to the board of directors, not to management. And they come in and they check things to make sure things have been done correctly, or as sure as they can. It's an independent party that's looking at the financial statements. Otherwise, companies could make up any numbers they wanted. Okay? So every publicly held company is required to produce audited financial statements. Okay. Next up, we have an abbreviation. And the abbreviation is SEC, the Securities and Exchange Commission. Okay, Securities and Exchange Commission. Okay, Securities Exchange Commission, which brings us to the next one, is our audited financial statements. Those ones that we're required to produce are filed with the SEC. Okay, so that Securities and Exchange Commission, we take our audited financial statements. So the auditors have looked at our financial statements and they have said okay or not okay. But we take those financial statements and they are filed with the SEC. And this public information that I use in class when we talk about 1-800-FLOWERS information, that's filed in a Form 10K. That Form 10K is their audited financial statements, and that's what we're looking at when we look at these public numbers. So audited financial statements are filed with the SEC. Okay, next up, we're at the bottom of page 2 on your handout for this next slide because there's a lot of writing on it. So when we talk about management, we're going to be talking about management versus auditors. Management is employed by the company. When we talk about management, we're talking about the CEO, we're talking about the CFO, we're talking about the managers at the company, the vice president. So the president, so the CEO, managers, those are management. Whenever we refer to management, it is the company's management. We're also going to be talking about the auditor. The auditor is the independent organization, the independent firm that we bring in to check our work. Okay? So, management. Management has several responsibilities when it comes to their financial statements. First of all, it issues the report on and declares responsibility for internal control over financial reporting. Okay? So management is responsible for internal control. It has to state that it's conducted an assessment of internal controls and the internal controls are effective and have been tested audited by the outside auditors. Bottom line, when we talk about management, is that management is 100% responsible for the financial statements. You cannot, as a manager, claim that you don't understand accounting. Enron, several years ago, when Enron blew up, the CEO of Enron, he was put on trial for criminal behavior related, because with Enron, what they did is they just made up numbers. They just completely made up. They decided what they wanted their income to be and basically just wrote journal entries to do that. So they put the CEO on trial and said, you know, you were responsible for this. His defense was, I'm not an accountant, I didn't understand the numbers, so it's not my fault. And that's what led Congress almost immediately to enact the Sarbanes-Oxley Act, which says management is responsible for financial statements. You cannot say, I don't understand accounting. So everyone who aspires to be a manager someday, know that you have to understand accounting. You have to sign off on the financial statements. If those financial statements turn out to be fraudulent someday, you are on the hook criminally for those financial statements. So you cannot say, well, you can say it, but it's not a very comfortable place to be. Oh, I don't need to know accounting. My accountant, I'll hire someone to do it. Well, that's fine, but you're signing off on it, and it is your responsibility. You cannot hire that responsibility away. It is your responsibility. So management is responsible for the financial statements. Okay, then at the top of page 3, this slide is at the top of page 3, about the auditors. So when we talk about the auditors, we're talking about the independent auditors, this external firm. And what they do is they examine the financial statements of these publicly traded companies. And then they determine if the statements comply with GAAP. GAAP is generally accepted accounting principles. And they decide if the internal controls meet standards, and they issue a report. A company having an audit gives credibility to their numbers. If companies were not audited, they could make up the rules as they went along. I, as an investor who have no knowledge, inside knowledge of a company, would just have to trust them that it was okay. And we see, sadly, so many examples of fraud that we really need those audits. It's someone looking over the company's shoulder on behalf of the investors. Okay, 2 main takeaways from all of this. First of all, independent auditors decide if financial statements comply with GAAP. GAAP is generally accepted accounting principles. Okay, independent auditors decide if financial statements comply with GAAP. GAAP is generally accepted accounting principles. So this is one of those major concepts. This one turned out kind of nice. Okay, so independent auditors, those are external auditors. You may want to make a note. Sometimes we refer to auditors as external auditors. Companies can have, as an aside here, companies can have internal auditors. They can have an internal audit department, and it's where they have auditors they've hired on their own, and these auditors are kind of like a watchdog, that they are not independent. They don't issue the audit report. They're there to help with company efficiency, to make sure we're complying with things, to make sure things are going well, but the external auditors come in, and they are the watchdogs. So independent auditors decide if financial statements comply with GAAP, generally accepted accounting principles. Okay, the other major takeaway, independent auditors decide if internal controls meet certain standards. Okay, so your independent auditors are also looking at your internal controls to make sure those meet certain standards. Again, management is responsible for the financial statements. Management is responsible for internal control. The auditors are responsible for checking both of them. Okay, so we know our auditors check our financial statements, they check our internal control. So we're going to have a couple questions now. So the first one, publicly traded companies have the option to produce audited financial statements, true or false? Okay, publicly traded companies have the option. We went over this. Publicly traded companies have the option to produce audited financial statements. When we're looking at this, the big key word is option, okay? Do companies have the option? Okay, that would be, this is a gimme here. You have 5 seconds starting now, okay? Publicly traded companies are required to produce audited financial statements. Okay, let's do. Okay, one more here. Publicly traded companies have to file their financial statements with the IRS. Publicly traded companies have to file their financial statements with the IRS. We just had one of those major takeaways. Let me go backwards on this one. Okay. Remember this one where we said audited financial statements are filed with the SEC. The SEC is the Securities and Exchange Commission. Okay. So we have to file our financial statements with the SEC. Okay, publicly traded companies, so the question is, publicly traded companies have to file their financial statements with the IRS. Remember, we just said SEC, okay? I'm going to close this in 5 seconds because we just went over the answer here. Okay, and that is false. We file them with the SEC, not with the IRS. When you file something with the IRS, you are filing a tax return. Financial statements are never filed with the IRS. The IRS never gets your financial statements. When you're a publicly held company, your financial statements are filed with the SEC. You fill out a tax return, which is a form. It's not a financial statement. Okay. Now, for most of the rest of the period, we're going to be talking about about auditors' letters and what's in an audit letter. Now, we're going to be using Caesar's Palace, and just so you know, because it keeps circling back to Caesar's Palace, I have no interest in Caesar's Palace per se. It's an interesting story because, first of all, most people have heard of Caesar's Palace. Secondly, they have some interesting things going on in that they're heading for bankruptcy. And so there's interesting things going on in a lot of phases of their business. So that's why we're talking about Caesar's Palace yet again. Caesar's Palace, what we're going to be doing is we're looking at Caesar's Palace Independent Auditor Report. And this is where page 3 and 4 of your handout have their audit report. So their audit report, Caesar's Palace Audit Report, is part of their Form 10-K that's filed with the SEC. When a company files its financial statements with the SEC, it also is their audit letter is in there. And the audit letter tells certain things about their audit. So what we're going to do now is we're going to go paragraph by paragraph through that audit letter. Okay, so the audit letter is in the handout pages 3 to 4. I've annotated the audit letter with paragraphs. Those paragraph numbers where it says paragraph 1, paragraph 2, those are not in a typical audit report, but that way we can all be talking about the same paragraph. And that handout for today, and Amir has it if you're online, it has the audit report there. Okay, so you're going to have to keep the audit report front and center. So as we talk about it, as we answer these questions, we're going to be answering the questions about that audit report. Okay, so these are general questions. So this would be, the audit report starts just a little bit down on the page, and the audit report, first thing, what is the firm name of Caesar's independent auditor? To find that information, whenever you look at an audit report, you look, actually we'd have to flip to page 4. At the very end of it, it will be signed by the public accounting firm, okay? So in this case, for Caesar's Palace, if we look on page 4, you'll see Deloitte and Touche, LLP. They're a limited liability partnership. They're a professional. They're a public accounting firm. They're one of the big 4 globally. They have a presence all around the world. And so Deloitte and Touche audits Caesar's Palace. So they wrote this letter. So that's the first thing you can do is look at who a company's auditor is. Okay, next question. To whom is the report addressed to? So now we're back to page 3, and we're going to be on page 3 for a while now. So to whom is the report addressed to? We look at it, and it is addressed to the board of directors and stockholders. Please note that an audit report is always addressed to the board of directors and the stockholders. The auditors are acting on behalf of the stockholders and the board of directors. It's not addressed to management, okay? It is addressed to the board of directors and the stockholders. By the way, each of these, I'm going to go through certain answers here, and then as soon as I finish this page, I'm going to put up some learning catalytics questions that are these questions. So you might want to make note as we go if anything's not totally obvious to you. Okay. For example, this one is going to be a question here, one more slide. It's going to ask you, I'm going to ask you, I think the next question or the second to next question, I'm going to ask, who is this report addressed to? So there's the answer. Okay, why are audits required for publicly held corporations? Audits are required. This is just a general question that's not in there, and it's to provide the public with additional assurance, some assurance that these results are real, that the company's just not making numbers up, that they've done testing. Okay. Okay, so we've gone through the firm name, Deloitte and Touche, who's the report addressed to. An audit report is always addressed to the board of directors and the shareholders. Shareholders and stockholders mean the same thing. And then why do we require them? Okay, so we're up to the first question relating to this then. Is to whom is the independent auditor report addressed? Okay, to whom is the independent auditor report addressed? We just said it. I'm going to be closing this in 5 seconds. Okay, it is always addressed to the board of directors and the shareholders. Okay, that's an important thing to know. It's always addressed to the board of directors and the shareholders. Okay, next up, we're going to go to paragraph 1 now. So paragraph 1 says, and I'm going to paraphrase some of this as we go. We have audited, so we're on page 3 of the handout, paragraph 1. We have audited the accompanying balance sheets and the related consolidated statements of operation, comprehensive loss, stockholders' equity, and cash flows for the 3 years, and also included the schedules. Then it says, these financial statements and financial statement schedules are the responsibility of company's management. Okay, so company management is responsible for the financial statements. We see that there again. And then our responsibility, meaning the auditors, is to express an opinion on the financial statements based on their audit. So there we go. So, and these, by the way, these audit reports, if you look at different companies' audit reports side by side, they're going to look very similar. The language is going to be very similar. They're almost boilerplate. Now, the reason we're using Caesar's Palace is they do have a few interesting things thrown in there related to their upcoming bankruptcy. Okay, so paragraph 1 questions. So what statements were audited? So again, we're going through answers now, and then I'm going to put up learning catalytics questions. So which statements were audited? The balance sheet, and we can just kind of look at the paragraph and see. It tells us, first of all, we've audited the balance sheet, we've audited the consolidated statement of operations, comprehensive loss, which is an odd thing that we really haven't talked about in here, but it's there, stockholders' equity, and statement of cash flows. So all those things were audited. They audit all the financial statements, basically. Okay. Next up, what time period did these financial statements cover? So these financial statements covered, the balance sheet was 2013 and 14. The other statements, 2012, 13, 14. The SEC dictates how many years have to be presented. We have to present 2 years of balance sheets, 3 years of other statements for comparison purposes. Who is responsible for the financial statements? This one will always be the same answer. We don't even need to look at the report to answer this. It's always management, company's management. Okay, and then what is the responsibility of the independent public accounting firm? Their responsibility is to express an opinion. Okay, so that's that last sentence in that. So that first paragraph is telling you what they audited, what's management's responsibility, and what's the auditor's responsibility. And that's very standard in the first paragraph. Okay, so now we're going to do some questions relating to this. Okay, and the questions all relate to just this paragraph, relate to just these questions that I just put up here. Okay. So, first one. This is one of those ones where you have to pick as many as apply and then submit. There's more than one answer. Oops. Okay. Which of the following statements were audited? Select as many as apply. Okay. When in B, when I say income statement, I put statement of operations in parentheses because the statement of operations is an income statement. Caesar's Palace calls theirs statement of operations. So which of the following statements were audited? You have to pick as many as apply. Okay, let's go back for a minute here. At the very top, what statements were audited? Well, I'm sorry. Let's go to paragraph 1. Okay? It tells us in paragraph 1 we have audited the company balance sheet and the related statements of operations, stockholders' equity, and cash flows. That's the very first sentence in our paragraph. So you should have them all selected. You have to press submit to submit this one. And we're now in the 5-second rule. It is all of them. Okay, next up, who is responsible for the financial statements? Who's responsible for the financial statements and the information communicated by those financial statements? Okay, there is only one answer here. Okay. I mean, that's my hint to you. You can pick more than one, but only one is correct. So make sure you've only answered one thing. Okay, who is responsible for the financial statements? Who's responsible for the financial statements? In our paragraph, the second to the last sentence of paragraph 1 says these financial statements and financial statement schedules are the responsibility of companies' management. So you're in a 5-second rule here. Okay. Always, always, always going to be management. Okay, and then one last question related to that first paragraph. So this next question relates to the last sentence of that first paragraph. What is the responsibility of the independent public accounting firm? And there is just one answer. Okay, look at the last sentence of paragraph 1, where our responsibility, that last sentence starts with our responsibility. That's referring to the independent public accounting firm. So you can read that last sentence as saying the independent public accounting firm responsibility is to what? And that's where your answer is coming from, the last sentence of paragraph 1. Okay, 5 seconds. Get your answer in. Okay. What is the responsibility of the independent public accounting firm? To express an opinion on the financial statements and financial statement schedules. Okay. The other answers. A, to express an opinion on whether investors should invest in the company? Absolutely not. Independent auditors have nothing to do with investor making decisions. B, to assure that the firm is properly calculating its taxable income? Absolutely not. No. They are coming in solely to say, here's the financial statements they express, are are these fair, and they also assess the internal controls, which we'll get to in a minute. Okay, so next, paragraph 2. So paragraph 2 says we conducted our audits in accordance with the standards of, it's called the PCAOB, the Public Company Accounting Oversight Board, that came directly out of the Enron scandal. They created this board, and this board has standards that require the public accountants plan and perform the audit to obtain reasonable assurance. I would circle reasonable assurance on there because that's important. It is not a guarantee. Just because a company has an audit does not guarantee that everything is correct. Hertz, you know, the rent-a-car place, they have audits every year. Certainly, they're a huge company. They have huge accounting errors, even though they were audited. So an audit will not guarantee that the numbers are right, but it's reasonable assurance whether the financial statements are free of material misstatement. An audit includes examining evidence, so they don't examine everything. They do test cases. When you take your stats class here and they talk about how big your sample is, those same stats procedures are used on audits to decide how many they have to test. They cannot test every single transaction. It simply wouldn't be cost effective to do that. So an audit also includes assessing the accounting principles used and the estimates made by management. When we talk about estimates here, we're talking about estimates like how long are we depreciating our property over, what interest rate are we using for present value calculations, etc., as well as evaluating the overall financial statement presentation. We believe our audits provide a reasonable basis for our opinion. Nowhere is there a guarantee that this is correct. It's reasonable assurance. Okay, so questions. What standards are used to conduct the audit? That's in that first sentence of paragraph 2, the standards of the Public Company Accounting Oversight Board. It's the Public Company Accounting Oversight Board. Okay, next question. Does the auditor guarantee that the financial statements are correct? Absolutely not. Only reasonable assurance. There is no way to guarantee that. Okay, what does the audit include? It's going to include examining evidence. So again, that's in this third paragraph. Examining evidence, assessing the accounting principles used, and evaluating the overall financial statement presentation. So that's in this paragraph. In paragraph 2, it's telling you that there's no guarantees, and here is what their audit included. So again, the major takeaway is it's not just Caesar's Palace, it's any audit. Any audit only provides reasonable assurance. An audit does not guarantee that the financial statements are correct. Okay? That's a major concept. An audit does not guarantee the financial statements are correct. It's only this idea of reasonable assurance. We do testing. This is reasonable. We're reasonably assured they are correct. Okay, so then next question. Does the auditor guarantee that the statements are correct? Okay, so on this one, does the auditor guarantee that the statements are correct? Yes or no? I'm going to close it in 5 seconds. Okay. Does the auditor guarantee that the statements are correct? Absolutely not. That's what I was just saying over and over, okay? There is no guarantee. The auditors absolutely do not guarantee it. It is reasonable assurance only. Okay, paragraph 3. So when we look at paragraph 3, it tells us that in our opinion, so there's a lot of legal language and dates in there. So basically it's saying, in our opinion, the financial statements present fairly, and that's the terminology, present fairly the financial position of Caesars Entertainment Corporation and the results of their operations and cash flows for each of the 3 years in conformity with accounting principles generally accepted in the United States. So there it's talking about GAAP, G-A-A-P, generally accepted accounting principles. Also, in our opinion, such financial statements scheduled present fairly the information, okay? So that present fairly says, yeah, we're reasonably assured that these financial statements do represent the financial position of Caesars. So when we look at here, the summary of the financial statements are presented fairly in all material respects, meaning maybe they booked $1 wrong or even $1,000 wrong, but that's not material. In general, is it correct? In all material respects, in conformity with generally accepted accounting principles in the U.S. And then what statements does this cover? Again, we're told that the statements covered are the balance sheet, the statement of operations, also known as the income statement, the statement of cash flows, and the financial statement schedule. Okay, next paragraph. So I don't have any questions on that one. This paragraph starts getting a little interesting because now this gets into where Caesar's Palace has some ongoing issues and some questions about whether it's going to survive. So the last 3 paragraphs we looked at are pretty standard boilerplate. You see them for almost every audit you see that report. It's going to look very much like that. So now we start deviating somewhat because of Caesar's special case. The accompanying financial statements have been prepared assuming that the company will continue as a going concern. So going concern, we talked about that assumption back in Chapter 2, so it's been a while. But going concern means that we think this company is going to continue into the foreseeable future. There are no indications that it might go out of business. It's a healthy company, going concern, we fully expect it to be in business on an ongoing basis. So it says that we prepared these financial statements assuming the company will continue as a going concern. Now it says, as noted in Note 1. Ooh, so Note 1, if I had time in this moment, we'd go over to Note 1 and read about it because this is where the notes to the financial statements can be quite interesting. It tells us, it is discussed in Note 1, the company is a defendant in litigation and other note holder disputes concerning certain transactions dating back to 2010 related to their subsidiary. Okay? Now, so they're saying there's lawsuits, there's litigation out there. And then it says the potential outcome of these matters raises substantial doubt about the company's ability to continue as a going concern. So here the auditors are raising the red flag that, hey, this company might go out of business. And it says management's plans concerning these matters are discussed in Notes 1, 15, and 22. This is where I've been saying all along, we have financial statements, but the really interesting stuff is contained in the notes. The financial statements do not include any adjustments that might result from the outcome of this uncertainty, of this litigation. Okay, so this paragraph is raising red flags. Wait, they're basically saying, hey, this company might not exist into the future. It might have to go out of business based on this litigation. Okay, so questions about this paragraph. What's a going concern? The going concern is that the company will be able to continue operation for a period of time. and sufficient to carry out its commitments, obligations, objectives, and so forth, okay? So going concern means, can we continue operating into the future? What is the auditor's opinion regarding a Caesar's ability to continue? There's substantial doubt. The auditor is saying there's substantial doubt. That is really strong language, okay, for an auditor to say that. Okay, and because the company's a defendant in litigation and concerns about transactions dating back several years. Okay, so the basic bottom line of this paragraph is that the auditor does not think Caesar's Palace is a going concern. If I had to guess, they're raising these red flags. They're not going to come out and say they're going under, but they are basically saying they don't think it's a going concern. They've raised this issue. Okay? So, question 25 before we move on. Okay, does the auditor think Caesar's is a going concern? They do not. Okay, they've raised these big red flags saying, hey, there's substantial doubt. So they do not think it's a going concern. So 5 seconds. Okay, paragraph 5. So paragraph 5, it says, discussed in note 10, so now we have another interesting note coming up. Caesar's Entertainment defaulted on certain notes. So what this is telling us is they didn't pay back debts. They had notes payable and they've defaulted, which means they did not pay them back, resulting in all of their defaulted debt to a current portion. Because they didn't pay it, it doesn't mean it goes off. It didn't go off their balance sheet. They still owe it. Now it's all listed as current because they're in default, which means the creditors are there, pay us back, pay us back. So they need to pay it back as soon as they get some money. And then it says, note 23, Caesar's Entertainment filed for reorganization under bankruptcy code. Okay, so they did file for bankruptcy January 2015. So what that paragraph means, what does the word default mean? The failure to pay the note's interest and principal when due. Summary of this paragraph, the company failed to pay back some of its long-term note installments, and they've been classified as short-term liabilities due right now. And then where in the financial statements would you find additional information? You would go into the notes to the financial statements. So in the financial statements, companies will list all their, they'll list their auditor letter, they'll list their financial statements, and then immediately following their financial statements are all the notes to the financial statements. And then paragraph 6, it tells us, we also audited the company's internal control. So this is another thing the auditors are responsible for evaluating. They evaluate the financial statements in accordance with GAAP, and then they also evaluate internal control. And our report expressed an adverse opinion due to material weaknesses. So what does all that mean? What's the main topic of this paragraph? To boil it down, it's an audit of the company's internal control over financial reporting. What's the opinion? It is an adverse opinion. Adverse opinion means it's bad. It doesn't meet standards. Their internal control is lacking, is what this means. So the word adverse is the important takeaway here. An adverse opinion means that the auditors say, wait, this is not good. You do not want an adverse opinion. They got an adverse opinion on their internal control, meaning their internal control doesn't work. They've got material weaknesses, substantial weaknesses, but we call them material weaknesses. Okay. So if we have to say what kind of opinion was this that their auditor issued, it is an adverse opinion is actually the terminology. So this is unusual. Most companies get what's known as an unqualified opinion. An unqualified opinion means there were no exceptions. You want an unqualified opinion. Caesar Sal's got an adverse opinion, which is bad. Okay? So adverse opinion about their internal control. Okay, so what kind of opinion is this again? Okay. 5 seconds. Okay, it is an adverse opinion. Okay, now we're going to do a couple questions that aren't specifically related to this audit report. The first one we may have seen in a different form. Okay, an audit report is addressed to the board of directors and the stockholders of the company. True or false? Okay, we can look, you can also look at page 3 of the handout, and that will be a refresher. It says to the. Okay, the audit report, an audit report is addressed to the board of directors or the stockholders of the company. True or false? It is on page 3 of your handout near the top of the audit report. I'm going to close this in 5 seconds. Okay, that is true. An audit report is addressed to the board of directors and the stockholders. Okay, next up, it is the independent auditor's responsibility to determine whether the company's financial statements comply with GAAP, with generally accepted accounting principles. So this goes back to a little bit earlier in class. Okay, it is the independent auditor's responsibility. We said the independent auditor has 2 responsibilities. They have to make sure that the financial statements comply with generally accepted accounting principles, and they also need to test the internal control system as well. So they're testing it where they're making sure the financial statements comply with GAAP, and they're also testing the internal control. So when we're looking at this, is it the independent auditor's responsibility to determine whether the company's financial statements comply with GAAP? Yeah, that's one of their responsibilities. It has to be. That's one of their 2 major ones. So I'm going to close this in 5 seconds. Okay, that's true. Now, this next one coming up will make you think for a moment here. Okay, the audit report is signed off by the corporation's management, confirming the audit was completed properly. I have not pushed this question out yet for a purpose, because I want to talk about this. What this statement is saying, what you have to evaluate, is the audit report, the one that the independent auditors prepare, where they're saying yes or no. Does management have to say, oh, they did their audit right? Does management assess? Basically, I want to do this question, but so would it make sense for management to have to say, oh, our evaluator did their job or not? I mean, so that's what this question is asking. Okay. This is actually false because I don't want to try to trick you or anything. Management doesn't evaluate the auditors. Management engages their independent auditors. Their independent auditors come in and evaluate management and issue this report. We don't want management saying they did their audit wrong because they don't. It's not. We're evaluating management. They don't control their evaluator. So this one's false. Closing in 5 seconds. Okay. Okay, which entity requires companies issuing publicly traded stock to have their financial statements audited by an external auditor? So who's associated with the audited financial statements? Who do we file them with? That's who requires it. So if you know who we file the audited financial statements with, you know who requires them. Okay, so when we look at this one, the SEC, the Securities and Exchange Commission, that's who requires companies to have their financial statements audited by an external auditor. 5 seconds. Okay, so back to the handout, there is one slide at the very end of the audit report. Not related to the audit report, it just falls in there. And this is when companies find an error related to a prior period. So we're going along and we realize we did something wrong last year. This is called a prior period adjustment. A prior period adjustment is we found an error. We have to fix it. So let's say we over-reported sales last year. We had too much sales revenue last year. We are not going to say, oh, let's reduce this year's sales, because then that messes this year up. So what we do is we take the adjustment and we have to correct retained earnings. So when we have a prior period adjustment, it goes directly to retained earnings. We do not impact income or expense this year. Okay, so when we make a correction for a prior year, it's called a prior period adjustment and retained earnings. So the big thing on this slide, the big takeaway is retained earnings. Everything goes into retained earnings. If it's a prior period adjustment, we are required to do an entry to retained earnings. You should have this written down because we're having a question coming up. Basically, the answer to the question is retained earnings out of this whole thing. If we have a prior period adjustment that affects income or expense, we don't impact this year's income or expense. We take it out of retained earnings. Okay? Okay, so then this comes up. Okay, so a prior period adjustment that corrects income of a prior period requires an entry to what? We just had it. I'm going to close this in 5 seconds. It is retained earnings. Okay, so that brings us to the end of the chapter. I will be emailing out step-by-step videos for the homework problems probably this afternoon. And Chapter 11 homework is not too bad. And that's it for today. Have a nice weekend, and we'll see you Monday.